everyone, I'm Thomas. Welcome to the Curious Investor episode. Here with Saxo, we are diving into the latest market trend and developments. Today, I'm with our Market Strategist, Redmond Wong, and we are discussing the topic about credit rating and how investors can use credit rating to form an informed investment decision. Hi, Redmond.
Yeah, thank you, Thomas. Thank you for asking me to do this episode again.
Oh, thank you. So the interest rate has been going up, as we all know. I've been receiving a lot of inquiries and questions from our investors, and they are very interested in investing in fixed incomes because the yield is quite high. Okay, so and this one puzzle and one confusion about when investors are investing in fixed income, they're looking in different parameters. One of the parameters we're looking in is credit rating.
Yes.
Okay. So how credit rating is working? Yeah.
It's a lot of investors initially quite a little bit confused by the credit rating, but I think once you get used to it, it's not really that difficult. Just like reading your own school report at your high school, and you have those, A, B, C kind of rating. But in fact, actually, you have been worked in the capital market department for quite some time, and that department actually help company to issue bonds. Maybe you can help the investor to do some hand holding, help them explain to them a little bit how the credit rating system work.
Yeah, indeed. So credit rating agency, there are three major credit rating agencies. There are Moody's, Fitch, and S&P. So let's use S&P as an example. So the highest credit rating can be assigned to any companies is triple A.
Yes.
And then there are double A, single A, and triple B, and then double B, and then single B, and C, and so on. So basically, A is better than B, and B is better than C. Okay, and within like triple B, you can have a triple B plus, triple B flat, and triple B minus. And one very important factor investors are looking in is if the issue rating is investment grade or not investment grade. So anything between triple A and triple B minus, they're regarded as investment grade. And anything below triple B minus is regarded as non-investment grade.
Yeah, Thomas, you just mentioned the term issuer rating. So how does it different from a bond rating?
Okay, that's fine. Yeah. So issuer rating is, you think about issuer is a company. So when rating agency assess about the credibility, the creditworthy of the company, they look at so many parameters and assign a issuer rating. So every company will have an issue rating. So, but when the company decides to issue bonds, so they will seek the rating agency to assign a to bond rating for the particular bonds. But the bond rating can have different things to consider before assigning the issue of the bond rating. So it can be, of course, the issuer, the company itself is a major factor, and also. Recent years, some company, when they issue bonds, they will enhance the credibility by having a guarantee from their parent company or having a letter of credit to enhance the credibility of the bonds.
Yeah, and I think I just want to add a little bit on that is the issuer rating is on the basis of a senior unsecured debt of the issuer. So basically, say, okay, so what I mean is the senior debt that rank higher. And then they are not have no collateral, but when they decide to issue bond, they can have credit enhancement. They can also have different ranking of seniority of the debt. They can issue subordinated debt. Maybe easier to explain. I think I can give an example. For example, HSBC. We all know HSBC, and so HSBC is rated by S&P. The issue rating and also the senior subordinate, senior unsecured debt is rated by S&P A minus, and then by Moody's is A3. So, but when they issue subordinated debt, and Moody's assign them a rating of Baa 1. Yeah, so there's one notch below their issue rating or below their senior unsecured debt rating. And we all heard about a lot of banks, like to issue those COCO bond or contingent convertible bond. Those are junior subordinated, so that is even lower in terms of ranking in the case of any liquidation and so on. And also the bank can choose not to pay coupon if they don't pay dividend and things like that. So basically it rank lower. And so for COCO bond or this kind of junior subordinated debt, usually perpetual, and they are, for example, HSBC's issue will be is rated by Moody's as a Baa3. So there's 3 notches below the issuer rating or the senior debt rating. So, but as you mentioned, they can also have credit enhancement. For example, also looking at HSBC, they have AAA bond. HSBC is single A name. How can they issue AAA bond? I mean, the trick is that some of those bonds are actually mortgage backed. Okay. So I mean, they're over collateralized. That means is the collateral they have is much. I think for one particular bond they have is 40% more than the bond outstanding they issue, and also those collateral, those mortgage loans actually have only a 37% loan to value ratio. It's very low. So basically they have a lot of security from the underlying mortgage loan portfolio. So that's why those particular bonds enjoy a AAA rating. So so the investor, when they look at a bond rating, not just they have to pay attention not just to the issuer, but also look at the detail of what kind of seniority of the bond and whether they have collateral and those features, but not too difficult, because it's usually the most common one. Usually just those are few type of bonds. So and I think any people here at Saxo can help you as well on that.
Yeah. So when you choose to invest in the bonds, so we have to pay attention about like is it secure, unsecure, the seniority, COCO or 81 as well. Mm-hmm. So before. Instead of waiting for the rating agency to assign the rating, can investor assess the financial health
of course,
of the company? Yeah.
There's 2 things I want to mention. One is, of course, is the investor also can follow the company. But before we go into that, I also want to mention there's some other information you can pick up from, for example, apart from giving a rating, the rating agency will also assign credit outlook. So if the outlook is stable, I mean that means that rating would be is less likely to be revised later on. But a lot of sometimes they will say, okay, the outlook is negative. That is a red flag. So if you buy a bond, if you have a credit rating of single A, and then the outlook is negative, then you have to be careful. It may be downgraded later on. And even worse, if the credit rating agency say this particular bond is already under review for possible downgrade, that is even worse, a red flag. So this kind of information investor can pick up and to have some ideas about the credit rating and also the price, because when the bond is downgraded, the price usually came down, and so we have to be careful on that. The second thing, yes, investor can also follow the creditworthiness or the financial health of an issuer. Just like stock investors also follow the company, but slightly different, emphasis slightly different. For stock investors, they will focus more on earnings, both historical and futures. I mean, earning growth, earning estimate, and that is because it's the investors in stock is looking for participating in the earning growth and the future of the company. And but for credit investors, they more interested in the financial feasibility of the company to settle or to pay the coupon, also to redeem the bond, and also the downside risk of the company. Maybe I can use some example. And for example, if for bank like HSBC, if we follow the credibility or creditworthiness of HSBC, probably we will look at the asset risk. That we're looking at also at the problem loan as percentage of the gross loans, For another type of issuer, those are very popular, and property developer, and that would be credit investor will be looking at the business profile and also the market position, the property market condition, and also very important to look at the leverage and like also the debt servicing capabilities. For example, like EBIT over interest expenses, so how much money you earn to cover your interest payment, and debt to capital, so your leverage, and also debt to EBITDA. Those are those very common ratios, and the credit investor look at. And also the maturity profile, how much bond are maturing in the next 3 years, the coupon payment, any call outstanding, or they put outstanding for those bonds, and those are very important. And the last example I would like to give is a technology company, and that's very different. This is, for example, technology company, you will look at where the scale of the company, because technology scale is very important. And with a lot of time, winners take all. So it's the scale in terms of the revenue, as market share in revenue and earnings, and also the profitability is also important, and EBITDA margin and operating income to asset, excluding cash. Those are very usual kind of common financial ratios. And leverage is also important, like debt to EBITDA and EBIT to interest rate expenses, and also free cash flow, especially with technology. A lot of people, a lot of investors will look at the free cash flow to debt. So, I mean, those are the very common. I mean, there's many examples. We don't have time to cover all them, but you can see the difference. I mean, it's leverage and ability to pay and the downside protection. So, one thing, it's maybe one more industry we should talk a little bit, because you are very involved in the insurance industry. You do a lot of credit analysis of an insurance company. Maybe you can also share a little bit. They're quite unique, actually.
Correct. Yeah. Especially for a general insurance company. Let's take an example of Japan, for example. So everyone knows that there are lots of earthquakes every year in Japan. So the Japanese insurance company will have a very big what they call a catastrophic reserve under the equity side. So how they assess the capital adequacy is depends on how big is the reserve in case if there's a big earthquake happening in Japan. So how well they can pay off all those insurance claim. So this is a very special feature of a general insurance company.
Yeah. Okay, that's very interesting, very informative. And so I think I hope that we can help our investors understand a little bit more about credit rating. But I think we're running out of time, so we probably have to do another episode in order to go into to look at the situation in other industry, and also about the debt issuing process and those will be also very interesting for our investors.
Okay, sure. Yeah. For more information about credit rating, and you can access on our platform. Actually, on Saxo Trader, you can look up many bonds and fixed income investment opportunity. And I think that's all for this episode.
Okay, very good. Yeah,
we're looking forward to see you again. Thank you.
Thank you.